So I want to thank you for joining us for our final day of spring training. Presenting today is Lisa Pavelski. She's the Director of Lending Protection and Customer Experience at TruStage, and she's going to talk about experiences and options that deliver on your borrower's needs with a focus on lending. Lisa, the floor is yours.
Yeah, thank you so much, and thanks for having me. Today, I want to make sure that we're going to walk away with how we can use data to impact member experience. I'm going to focus on lending, but I want to just reiterate that this is really applicable to all the experiences for your members. We are going to talk. Really want to make sure that we're building our members' financial resilience. And while financial services are really like second nature to all of us on this call, our members aren't the SMEs like you. And so today we need to sit in their shoes and spend some time coming from a place of empathy. We want to make sure that we're spending the next hour really grounded in this question that I have on the screen. So, looking at your lending experience, at what point in your experience are your members the most confident, and where do they become the most exposed? And how we'll get there is by exploring in three big parts. We're going to use TruStage's first party quantitative data as well as some qualitative research on what your borrowers worry the most about, what they value and expect from you, and thinking about how modern lending can build trust. And finally, I'll share a personal use case on how TruStage has taken this information and built experiences for both your borrowers as well as for credit unions. This is a pretty scary chart, to be honest with you. This is the New York Fed's quarterly report on household debt from Q4 of 2025. Total household debt increased by 191 billion to hit 18.8 trillion in the last quarter of 25. It's clear that there's no shortage of US consumers who are using loans and finances to live their lives. But what I want to do today is make sure that we're talking more about what's behind these numbers, that we're talking about the people that are impacted. When you think about loans, we may not be just thinking about the charts that we just looked at. We need to be thinking about about the people behind those and what's driving the action needed for that loan, whether it is to buy a car or fix their house or go to school. What are their wants and dreams? Loans aren't just a means to access money. They're a key part of how consumers are managing life's transitions, navigating uncertainty, and building towards long-term financial resilience. That's why at TruStage, we spend a significant amount of time and resources really researching borrowers, your members, and their needs and preferences for lending options and what they expect in the experiences that we all create together. To begin, we're going to really uncover what borrowers really worry about, what they value the most, and how they prefer to engage with your financial institution. But what you'll see here is the blue plus the green equals the worry for the current state of what they're most concerned about. So you can see we do this study every 2 years. So you can see the numbers in blue are for 2023, and then the aggregate for the green is the increase in concern as it relates to 2025. The biggest jump since 2023 about consumers' concerns about being able to make their loan payments really resides on losing a job and how that would impact their ability to manage loans. That increased 23% since 2023. But I think there's even something that's more striking here. Consumers just aren't worried about one or two things. On average, they're selecting 6 different life events that could put their financial stability at risk. So not only are we're not only concerned about one thing growing in exponentially, but they have vulnerability across multiple fronts, and they're looking for solutions that offer both protection and peace of mind. Where do those concerns come from? It comes from the fact that they've had experience financial setbacks in the past. 73% of borrowers report having experienced at least one or more financial difficulty that has impacted their ability to pay a loan. This highlights how common strains are amongst our borrowers, and it's really the exception and not the norm. Over one-third of borrowers have missed at least one payment, whether that's for a credit card or a loan. And nearly one-third say that they've experienced a situation that negatively has impacted their credit. We found that credit card use specifically has changed recently. 34% of consumers are relying on credit cards to cover their rising day-to-day expenses. They're experiencing significant financial strain, with many relying on credit cards to cover rising costs. They're living paycheck to paycheck, and they really do feel vulnerability should something unexpected come up. They don't have those residual money and savings to cover those events. But these just aren't real numbers. And here we're sharing what people say in their real voices from our quantitative research. There's something you could, and this is really something that you can do with your members. So even though the numbers paint a picture of doom and gloom, I like the way that the consumers are describing a picture of their current financial status, like the one over on the left that talks about how they could still touch touch the ground of the swimming pool. People express a deep sense of responsibility and honestly pride on how they manage their expenses. It reminds us that behind every data point, there is a human being with a story. Consumers' sentiments on loans, they're seeing a rising recognitions that really a loan or a credit card is a key part of how they manage their financial well-being. 80% of consumers now believe that loans play a critical role in providing financial stability through the different stages of their life. They also have increased openness to using loans for debt consolidation, and we're seeing a notable uptick in interest in protection products like gap coverage, mechanical repair, credit insurance, and debt protection. Consumers know that lending is part of how they're going to manage, but they also want the peace of mind that they're looking for safeguards to help weather uncertainty. I think this one is pretty interesting because it matches past experience, which you see in the blue, is somebody who's actually experienced one of those issues. The yellow represents those who have worry about that. Many people are worry and live in that what if state. Taking illness and disability, for example. So 24% of borrowers we researched have actually faced a financial setback. Yet 62% say that they have concern if something would happen to affect their ability to make a loan payment. Or job loss, 23% has actually experienced it, but 54% are concerned about that. This just tells us that our borrowers are thinking ahead. They're worried not just about today, but they're really looking at tomorrow's risks. And it gives us a powerful role with your credit union that you can play in those borrowers' lives to not only support the borrowers who are facing setbacks, but also being proactive about educating people on how to prepare for the unexpected. We can help reduce both financial vulnerability, that emotional stress by offering the right loans, the right solutions, and the right support. Financial decision making is not super straightforward for our credit union members. A large majority struggle with confidence. 85% of credit union members report having difficulty making confident financial decisions, showing a widespread of challenges across your membership. The biggest barrier is really having access to the right information and comfort with the risk of making a major decision. And I really think the takeaway here for all of us is a large majority of credit union members struggle to make those um, confident financial decisions. And that's really where we can lean in and use our knowledge to support and help build confidence. So, to recap what we just went over, we have worried members. They have a desire to use your lending products to build financial stability, but really lack the confidence in their ability to make decisions. We're going to shift a little bit now and really spend some time talking about what their expectations are for you as their primary financial institute. The headline here is expectations on your credit union are increasing, and they're increasing both online as well as in the human process. Often we jump to believe that these expectations are all about either digital or speed, but for lending, they're increasing across both digital and human aided support, and the expectations for same day approval or denial really remain the same from 2023 to 2025. It's interesting to see the expectations for a follow-up call from a person, though, has increased from 33% to 42%. Similarly, the expectations to chat or call a representative have increased. So it's clear that your borrowers are expecting seamless experiences across both digital with the ability or reassurance that a real human is there to help them should they need it. More things are really starting to matter more, which is very interesting. Um, this year, just much like what we saw in 2019 and 2023, consumers continue to prioritize the monthly payment and interest rate when they choose a loan. However, the data shows that the percentage of people who ranked these as their top or second have actually decreased. What's interesting this year is that other factors have gained importance, such as approval speed, opportunity to save on an existing loan, and additional loan options, really suggesting that while the right payment amount at the best interest rate is crucial, it's not always the only factor when your members are making the decision to lend with you. They're looking for more, and again, increasing consumer expectations for the holistic loan experience. And they're applying using multiple methods, and they're applying for multiple loans. We asked recent borrowing consumers to tell us how they applied or plan to apply for their most recent personal, auto, or home equity loan. And they told us that we told them to pick all that they plan to do. On average, it's up a bit. Consumers say that they will or did apply through an average of 1.7 different methods. 95% of them said that they planned to apply to at least once using an online application. But what is interesting is there's still 52% of people who say that they are going to apply in person with their PFI. Human help still matters. We ask consumers what they prefer when it comes to channels across the steps of their loan, which is better, which is they do they lean on most. The green really refers to the some part of the experience where they prefer it in person. The pink is where they prefer it online with some human help, and the blue is online with no help from a human, and the gray is just really no preference. Now, but what may surprise us is that, again, despite the rise of digital everything, a strong majority of consumers still prefer channels where they feel like they get some level of human help. This is true across all the different steps of the borrowing journey, and even applying for a loan. 66% say that they still want some human help. The only exception is when consumers are doing their research for their loan options. At that stage, many prefer to do it online by themselves with no human help. So, really important to make sure that you're providing really robust information for your members online, supporting them the way that they expect. But we're also seeing about 25% of consumers who prefer to do everything online with no human interaction. That's a significant group of borrowers. lending institutions really need to think about how they're serving each of these members differently and how you can meet the preferences of each of those. It's not a one size fits all. In my experience, is going to be very different than what Dean is going to want in his lending experience. So I want to share how TruStage is taking our research to identify these opportunities to protect more of your members. And then we're going to really think about how we take these insights and flip them into measurable action that delivers business value. On this slide, the green bar represents pre-borrowing populations, kind of showing us a large interest in the different types of payment protection. And then the gray is a flip of that. That is borrowers surveyed after their loan was finalized. And what you can see here is that there's a pretty big gap in there's a lot of interest and likeliness to buy payment protection, yet those people who have recently got a loan, nearly 50% don't remember being offered payment protection. This outlines a big opportunity for all of us. So my first job to be done as a payment protection provider is to ensure that 100% of your consumers are offered who are applying for a loan are offered it regardless of their channel. And then the next question that people always ask me on this is, so I included this slide for you all, is, oh yeah, but tell me if it varies by income level. And what I think is really interesting here for credit union members, that we tend to have a bias of people of higher income aren't interested in payment protection, and that's actually not the case. For credit insurance and debt protection, there is virtually no difference in likelihood to take product based on some of the demographics like income or sex or age. And so I really challenge you to think about what might be some of your own preconceived notions about your lending and how that might be coloring your decision making that could be negatively impacting your bottom lines. Why do consumers elect payment protection? It really goes back to financial resilience and overall well-being matters. 82% of consumers who said that they were somewhat or very likely to elect payment protection on their loans. Why do they say that they'll elect that? It's really about just what insurance does. It helps build on a promise, providing peace of mind and security. No, now I know that that is important for my marketing materials. And then I have to make sure that what I'm providing to you meets that need to make sure that we are really conveying that need of peace of mind and security. And then, just like any other product that a consumer might buy, we ask them, what are those two things that you would need to know to make a confident decision? And probably just like buying, that lipstick on Amazon, you want to know what that product is going to cost you and what it's going to do to cover you. This creates my next job to be done. I have to make sure that I am laser focused on delivering those two outcomes when providing materials for your members. But when is the next question? And I think the answer here is a little bit interesting because what is important to me is not necessarily important to the next borrower. It depends on that consumer. But almost three-fourths of the population expect to hear about payment protection multiple times during their lending event. And it's really easy when you see a slide like this to just feel like you need to boil the ocean. But what we decided to do is focus on that big block around the time where they're at the members are at their application process. It's our highest opportunity, and that's where we focus on making sure that we have 100% offer at time of application. Now I want to share how we are going to take all of that general information, all of those opportunities that we identified in section 2, and match that back to a business opportunity to take action. We use the quantitative research to spot some clear measurable trends. We know that over 90% of borrowers worry about their ability to make their loan payments if a life event happens. 82% say that they would be interested in electing payment protection on their loan. That tells us that there is a real need and there is relevancy. but only half recall being offered protection. And that lies with with our major opportunity. We've also learned that consumers expect to hear about our products multiple times in different ways. They want to know what the product does and what it covers. There's a strong push to lead into making sure that we're conveying peace of mind and the job to be done around how do we integrate this into into your flows. Sometimes it gets really confusing about what your members need and what is really an integrated experience. So, just like any good technologist, I asked ChatGPT and specifically the what to financial services, what are define the four key attributes of an integrated experience. Any experience, first and foremost, needs to be member centric. Putting them at the center of your design, integrating experiences strive to cater to the member's needs proactively and intuitively. Second is really accessibility. It ensures that members can easily reach the services that they require, whether that means fewer clicks in a digital interface or faster response times from a service provider. Really, access is key. Next is timeliness. Ensuring that services are available precisely when they need it is essential. That means for your institution, 24/7 availability or quick onboarding processes. We have to streamline those processes. Integrating that experiences are focused on making financial processes as most efficient as possible by reducing the complexity and the steps involved in accessing their services. So, in summary, an integrated experience in financial services seeks to seamlessly blend various processes into a singular, cohesive, user friendly access point tailored to meet your members' needs efficiently and effectively. But we also need to do a reality check. So, this is some information from your peers, and we want to know what credit unions' expectations are on how fast they're thinking about digitally automating their lending practices. The answer is really a mixed bag. So the inner circle is related to what they reported in last year, and then the outer circle in the lighter shade is the expectation 3 years from now. And you can see that there's a big push to make sure that all applications are could be able to start digitally, but really that fully end-to-end process all the way through is slower to be automated, with only 23% automating it fully today. And when we ask for some quantitative information, that tends to be credit cards or personal loans that we're seeing the most automation. So I want to share with you what our first iteration of our digital experience, where we integrated our payment protection into a loan application process. And again, it was very much iterative in nature. First thing is we're just going to drop some information into the loan application and see what happened. We got about a 2% engagement rate. So we have had a starting point. Not great, but we did something. We started. The next iteration, we just made it more visually appealing. We added some colors, we added some iconography, and jumped to 8%. And anybody who works with the marketing department knows when you can see that 400% increase, you're pretty excited. But the real unlock for us, where we got the most engagement, is not necessarily what it looked like, but where it was presented. Your members are, when they're applying, they're just filling out the form. They're not really in read mode, they're in fill mode. So when we moved our payment protection messaging or any of your cross sells, for instance, to the review page where they're spending their time and switched to the of the cognition of reading, we saw a 44% engagement rate, significant, So, really thinking about where that major unlock happened was less about what we were putting on the page and more about when we were presenting it. We also had some unexpected outcomes with our digital experience. We were really worried at the beginning that we would see members choose lower value packages when left to their own choices, but it's actually the opposite happened. When we compare our online close rates for our payment protection versus the offline experience, we're actually selling 20% higher value packages online, which is really interesting when you think that a member sees the price and is able to weigh those options. They're actually picking higher value packages, which kind of goes back to one of my earlier thoughts around, do we have some type of bias where we think that a price point is a barrier to entry and not give our members all the options available to them. So another thing to be thinking about when you're presenting different options to your members. And we just need to make sure that we're measuring success not only by what the members experience. We want them to have personalized experiences where their needs are anticipated. We want to make sure that we're providing education and general understanding, that we're staying inside of your lending experience and not doing anything to negatively impact your loan application close rates, and that they were helping them save time and hassles on the member side. But we also need to think about the expectation of you and your loan officers. We want to make sure that we're increasing the relevancy of our products and our experiences. That again, we're giving you the opportunity to make sure that 100% of your consumers are offered the product, that we're doing things that are helping to build your lender efficiency, um, and that you're seeing higher opt-in rates. So when you're thinking about those experiences that you're building digitally for your members, you really do need to think about your staff and the other stakeholder groups that will be impacted. We've even seen times in our past where our claims experience, which we thought was, the cat's pajamas, um, coming out of the gate, was actually causing more calls into our call center instead of less calls. So we've spent a lot of time thinking about, again, how to look at that experience to make sure that the your members are getting what you need. So you do need to make sure that you're balancing both. And looking at measurements. Since our inception of our integrated experiences, we've serviced over 750 credit unions. We've had 4.6 million consumers flow through our offer, and we're seeing a 13% increase to loans protected for consumers who do see our product digitally. And we have a 97% credit union net promoter score. So again, continuing to look at your data, I look at it on a weekly basis to see if there's anything that's happening from an outlier perspective that allows me to capture information right away. And I guess the story here is once your job's done, your job's really not done. There's an opportunity exists to deal with, to service some of those members in other places. And that's what we're doing now, is thinking about how we can drive more confident purchase post application through funding, and actually even looking at post loan opportunities. In fact, we just did this really easy test where we sent an email to applicants 2 hours after they had applied, but still weren't funded. And we saw a 36% increase in protection for those consumers who saw both the offer in application as well as that email versus no message. Really exciting results, and starts to have us continue to think about what's next for all of us. So, my key takeaways and what I really want to leave you with is this. I think it's very important that we're all getting very inquisitive, that we're using not only data that's out in the universe, things like your partners like TruStage can share with you, but your own first party data to get inquisitive. You need to plan how you're going to move forward with a very intuitive roadmap that lets you take small steps to try to drive improved experience. And I really urge all of you to just take action, do something, build your roadmaps based on your own member insights, build, measure, iterate, define what's next, and continue to improve. I want to thank all of you for taking your time out of your busy day to learn with us. Should you want to learn about TruStage's digital integrations, there's a QR code here for you.
Just on some of your statistics. So on one of the slides, you said finalize loan and paperwork. 55% of them are doing that in person. Is that because of the people that you surveyed, that was all that was being offered at their institution, or is it just what their comfort level was?
So what we see is it's their current expectation or what they're currently doing at their PFI. And sometimes, again, like those numbers did vary, Dean, based on different types of loans.
Okay.
Um, and knowing that obviously with auto loans, for instance, you need to gather some of your collateral information and different things. And then also too, we all know that and we saw that in our own data that fraud is still a major concern for our in the credit union space and financial institutions in general. So there is a desire to stop some automation just to do some validations on fraud. We're also seeing a lot of credit unions using the lending event to try to cross sell and upsell and build a more nurtured relationship with their members. And oftentimes that's okay if it isn't a friction, if your members are seeing it as a value add and not a place where they're not getting to their money as quickly as they need to.
When people are looking to take out a new loan, whether it's for auto, probably mostly for auto, do you know what percentage are shopping by payment regardless of what the terms are? Like they're determined they need a new car, this is what they can afford, and they're kind of walking into the dealer without probably being well
Uh,
informed.
what I think is interesting here is that still the most important thing is that average monthly payment, still the highest factor,
Percent. Okay.
but it's actually decreasing in its overall importance. And I think what I mean by that is that there are other things that are sneaking in for other people. And that's what I think is really interesting. If you look at, again, it's really easy when you're in a low interest rate environment that you're really focused on that monthly payment because you're not thinking about the total cost of your loan. But things like fast approval ratings are actually coming into a higher value. Certainly not beating the amount of the monthly payment as
Right.
the number one factor, but it is increasing for people. And so I think it is important that not only do we think about do we have a compelling offer, but can we get that member through the flow as fast as possible to get them into whatever they need.
Something else interesting on the screen that I found was now that you've pointed out people shopping by their monthly payments. So that decreased by 11%, but
Mhm.
people looking to consolidate loan and debt options has increased 3%.
Yep.
So different ends of the spectrum. I guess it depends
Mhm.
on who's shopping for what and what their financial situation is. And I'm actually surprised that the amount of the payment isn't higher, given today's economy. So we are not able to share the slide deck directly with the credit unions. But if there is a certain slide that you are interested in that you would like to share internally, please reach out to me and I can reach out to Lisa to have that sent over to you. I appreciate you joining today's session, and I wish you a great afternoon. Thanks.
Yeah. Thank you for having me.
Thank you, Lisa.
Enjoy your day.
Thanks. You as well. Bye
Bye.
now.